To chat with us, Dr. Lal Path Labs. For Q3, the company's top-line growth was purely driven by volumes. Margins were slightly under pressure. We have Shankha Banerjee, CEO at the company, now joining in. Thank you very much for joining in. First, if you could guide on the volume growth, will the company continue to focus on volumes? Is that going to be the driving force for you? What could the volume growth look like going forward?
Right. Thank you for having me on the show. Firstly, for us, volume measures, there are two of them that we look at quite closely. One is the patient volume growth and another is the sample volume growth. So this quarter, our sample volume growth is 10.3%, which is more or less in line with our overall revenue of 10.7%. And our patient number volume growth is at about 3.8%, which is, and at a YTD level, we are at a 4.4% on patient volume. So I think our sample volume growth is really doing well. In terms of patient volume, pre-COVID, we used to have numbers in the range of 7 to 8% patient volume growth. And that's a number that we are definitely have in our sights to reach, in the future.
What about on margins? Because in the past, we've even seen margins of 29-30% for you. In the current quarter, it's down to about 26%, or even in the prior few quarters. What is the outlook on margins for Q4? And would you maintain your EBITDA margin guidance of 27% for FY25?
So Q3 has always been a structurally, what would I say, a slow quarter. And typically our H1 margins have been better than our H2 margin because a lot of our investments and other costs kind of start getting built up during the second half of the year. But even if you look at our YTD margin numbers, at YTD level, the first 3 quarters put together, we are at about 28%. Margins are still quite healthy. And, the guidance that we have given between 27 and 28% for the year, I think for the overall year, we should be in that range.
Okay, so 27 to 28% margins for the full year. But are you focusing a bit more on volumes over pricing? Is that going to be the strategy? And what about price hikes? Because your peers have taken some hikes in the prior quarter, but you've been a bit hesitant to announce increases.
So, yes, our focus is definitely, for a sustainable growth. We would like to see, volumes also rise along with our revenue numbers. And therefore, it's been a conscious choice to, not take price increases. We are aware that in the market, there are other players who are taking price increases. But given our strategy of, looking at, a sustainable volume, really, underlying our revenue growth, we are still not looking at price increase in the near future. However, we keep reviewing the position. So it's not as if it's never. I think we will keep reviewing every 3 to 6 months. We review our position and then we decide accordingly. But we don't have an intention to take any price increase in the near future.
Do you fear that if you take price hikes, you won't be able to maintain a volume growth of about 10-11%? Is that is that the market dynamic right now?
So it is not about whether we'll be able to maintain or not. I think, like I said, for a longer sustainable growth, we want to see our volumes inch up a bit more further. And then, as per our strategy, where, we are expanding quite aggressively into our tier 3, tier 4 markets, where a lot of competition is from the local labs. Pricing also plays an important factor in trying to get conversions and, growing the business in those markets. Therefore, we are consciously not taking price increases now, but we keep reviewing our position and we'll see, when we think that the need is there, we will also look at price increases.
Yeah, absolutely. Mr. Banerjee, good morning. Prashant here. Did we get through to what your expectations are for revenue growth in FY26?
So, this year we have said that we want to go better than last year. And last year we were 10.4%. Right now, I think we are at about 10.7% on a YTD basis. So more or less in the range of, say 11%, 10.5 to 11%, which we've been saying, for this year. So our next year aspiration would be to obviously better this number. And that's kind of, we'll be targeting a revenue growth which is better than what we will achieve in this financial year.
By, small margin, big margin, is there a possibility for big delta there? Say closer to 15%? I mean, obviously everyone aspires, but is it looking like it could be in that vicinity?
So you see, revenue growth has multiple contributors. There is volume led, there is a mix change, there is a price angle, and also there could be possible M&A angle. So right now, I think what I am talking about is pure organic growth without looking too many or considering too much of a price increase. So volume and mix improvement, we would like to do that better than what we end up this year.
And do you think next year you will be able to maintain margins within the 27-28% band?
You see, our long-term margin profile has been in the range of 26 to 27%. And, I think we also spoke about adding, new infrastructure. So, opening 15 to 20 labs this financial year, which we are more or less, we are actually on track for doing that. And similarly, we may have a similar plan for next year in the same range of opening new labs. So overall, I think we would be looking at a range of between 26 to 27% EBITDA margins going forward on a sustainable basis.
Got that. Now, what you mentioned, right? The guidance aspiration is all based on organic, but there's always obviously the inorganic angle as well. You've spoken about this in the past. You closer to it? Closer to doing anything?
So, we've said that for us, South is a market where we are really trying to build our maybe base through inorganic opportunities. So, South and West are the geographies which we continue to look at. There is, some activity happening on that side, but as of now, there isn't anything that we are in a position to really speak about.
I see. So maybe South. Right? I mean, West, you obviously did one acquisition earlier, but these are the two geographies, largely.
Largely West and South, South and West, because South contribution to our overall business is still in single digits.
Very low, yeah.
So, that's one area where, and South in itself is a very large geography. You've got 4 large states, 5 large states now. So South is also not homogeneous. So, there are, geographies within that we are looking at currently. That's really a main focus.
The large market, because generally the perception is that primary healthcare, etc., is much better in that sense, or that doesn't make a difference.
So yes, the healthcare establishments and the organized play there is better than maybe what we see overall in North. But still, I think the opportunity for M&A, etc., will be there, and we are looking at opportunities, and it's not as if retail pathology does not exist there. There is enough scope for doing retail pathology there as well. So that's what we are focused on.
Thank you, Mr. Banerjee, for joining in. Wish you all the very best. Thank you. It's been a good conversation.